Hi, my name's Steve Walker from Promise Money, and today I'm talking to business owners who want to buy a commercial property. And I want to go through the factors that affect affordability, and that means how much you can borrow. And I think you're going to be pretty startled by what I tell you. So generally speaking, if you're a business owner and you're looking to buy commercial premises, you're going to be able to borrow up to 75% of the value of the property. There are exceptions to that. You can go higher, especially for dentistry and doctors, where you can potentially borrow 100% of the value of the property, maybe even 100% of the value of the business. But let's talk about your bog standard commercial property, commercial business. You're looking at about 75%. But the other factor that you have to take into consideration is affordability, and I want to talk through that right now. So what I want to talk about is the EBITDA, EBITDA, which is what lenders tend to use to assess the affordability or the income of the business. And that is earnings before interest, tax, depreciation and amortization. Now, I don't want to get bogged down in all of that, but the ones that are important are tax and depreciation. Those are the ones that have the biggest impact. So what they're going to do is they're going to look at your profit. But I want to just talk through that so you understand exactly what I mean by that. So let's say you've got a business and you've got sales of £500,000 and you've got costs of, let's say, £400,000. So you've got a profit of £100,000. Okay, so we're all happy with that so far. And potentially you'd pay tax on that, corporation tax. If you're a limited company, if you're a sole trader, it's different, but you might pay tax on that as well, of £20,000, which is going to leave you £80,000 to support the borrowings. Now that might seem fine, but it's not as simple as that, because if you're a sole trader, you might be paying yourself all of that. If you're a limited company, you might be taking all of that out as dividends. If you take it all out as dividends, there's nothing left to support the loan that you're going for. If you've got a company that's got loads of surplus profits, you're not taking it all out, then you're in a better place. Okay, you're in a better place as far as the lender is concerned when it comes to borrowing. So what do we do in this sort of situation? We've got £80,000 here, and let's say you're taking it all out as dividends. And why shouldn't you? You know, it's your business. You've got the profit there. Take it out as dividends. So what we would do in that scenario is we say to the lender, right, Mr. Smith or Jones, or whatever you like, is taking these dividends out because he's entitled to, but he doesn't need them for his personal living expenses. And we would justify that by use of a document we call an ALI, which is Assets, Liabilities, Income and Expenditure document. We send that to you, you fill it out, and you put on there what your outgoings are. So your income and your outgoings, so that we can see how much surplus there is. And if your income with all your dividends is, I don't know, let's say it's £100,000 a year, but we can evidence that you only need £30,000 a year from the business, then we can add that other £70,000 back. Does that make sense? So if you've got income from elsewhere, it could be that you don't need any of the dividends. You're not taking any money out of the business at all. You don't need to. You take it because you can, or you might have taken it as one-off payments, or you might have built a swimming pool, or you might invest in stocks and shares. That's for you to do. But if it's not part of your regular outgoings, then we'll look to add it back. So that's how we get back to the £80,000 if we possibly can, or as close as we can. And the other figure that we might be able to add back, let's say you're currently in rented accommodation. Your business is running from a rented premises, but you're looking to move into one that you're going to own. Well, when you do that, you're going to get rid of the rented premises. You'll no longer be paying rent. You'll be paying mortgage instead. So in that case, we can add the rent back as well. And the other thing is which we're going to add back is depreciation. Those are normally the big numbers that we have to play with. So that will get us to a number. Let's say in this case, you've got £80,000. You're taking it all as dividends, but you're currently paying £40,000 in rent. We can add that back. You've got £10,000 in depreciation. We can add that back. And of that 80,000 you take in dividends, you don't need to take 30 of it, and we've evidenced that to the lender. So we're back to our 80,000. I'm doing that because I'm lazy to make the numbers easy. I've got £80,000 to play with. So that's how it works. If you're a sole trader, then we go through a very similar exercise, but of course it won't be dividends. You'll be taking out drawings, etc., etc. The key point here is there has to be enough left in the business to support the borrowings that you're looking to take on. We either have to add back costs that you've currently got and you won't have going forward, or we have to evidence that you've got the affordability, or you might have so much profit in the business it really doesn't matter. So that's what we're dealing with. So now let's move on to how lenders will assess the affordability based on that number. Before I move on, I just need to clarify something. A moment ago I was talking about a figure of £80,000. I did say at the start we can also add back the tax, so that would actually go to £100,000. So remember, it's the pre-tax figure that we're going to be working on for affordability. Okay. To make the maths easy for me, not for you, but for me, let's work on, we've assessed the EBITDA to £50,000. That's how much extra cash there is available, disposable within your business to support your proposed borrowings. So the lender's going to take that figure, and depending on which lender we're talking to, they're going to have a different approach. But they're going to look at the interest rate that's being charged. They're going to look at the stress rate. They're going to look at the debt service coverage ratio, and then it depends on the type of loan and the term of the loan. But it's all about affordability. So interest rates, well, on commercial mortgages, it's a moving feast, isn't it? It's a moving feast, but at the moment, we are looking at, well, anywhere from, if you talk about fixed rates, from 5.5% to 10.5%. But the key thing here is the stress rate, because some lenders, and let's take a high street lender, they might say, right, we'll give you a loan at 2.9 plus base, but we're going to stress that rate, i.e. we're going to assume that the rate's going to go up in the future. So we're going to stress it to a higher rate than we're actually charging you. We're building ourselves in a safety factor, and most lenders do this. And high street lenders could easily be stressing at 8.5%, 8.5%, easily be stressing at that. So even though you're going to be paying potentially a lower rate than that, they will assume a higher rate, and they'll build that into the calculations. I'll show you that in a minute. The next thing is the debt service coverage. Now, a high street lender is going to, ideally, if the repayments are £25,000 per annum on your loan, and that's at the stressed rate, they ideally want you to have nearly double that available to support the loan. So even though the stressed repayments are £25,000, they'd like closer to £50,000 available. And the reason for that is they're very risk averse. They've been there before. They've seen businesses where they've had a downturn, and they want to factor all that in to protect themselves and also protect you. And typically, a high street lender, actually, they work on a debt service coverage ratio, DSCR, of about 175%. So I'm going to run through some numbers just so you can see the massive difference in the amount that you can borrow depending on the lender. So we'll take a high street lender first. And let's say they stress at 8.5%, okay? We've got £50,000 available. So that's our target number. We've got to get you a stressed repayment and debt service coverage figure in that comes in under 50,000, because that's all you've got to support the loan, okay? So if we've got £50,000 available at 175% debt service coverage, that gives us £28,500 to support the repayments on the loan that you're going for, okay? £28,500. So that's about £2,375 a month. So high street lenders are going to say, right, if you apply our stressed repayment over a 25-year term, we need to get a repayment which is under £2,375 a month. Okay, that's going to get you about £300,000. So high street, you've got £300,000, and we've stressed it at 8.5% times 175% debt service coverage. We've got £300,000 from the high street lender, and just because they're high street lender, it doesn't necessarily mean they're going to be the cheapest. So I'm going to go to another end of the market now. High street lender, and you probably all think, oh, I'm going to get the best deal from the high street. You're not necessarily, because their fixed rates at the moment are actually higher than some of the specialist lenders. That's probably because they look further into the future, or they're more risk averse, therefore they are offering higher fixed rates. So let's talk about a specialist lender. And these rates won't be correct at the time you watch this video, I'm sure. But right now, we've got a specialist lender who's doing 5.6% instead of 8.5%, and they're doing 125% debt service coverage, okay, on a capital repayment basis. So they work out the repayments over a 25-year period, but at a lower interest rate and a lower debt service coverage. So that means with this lender, even though you've got £50,000 the same profit, they will use £40,000 of that because it's 125%. 40,000 times 125% equals 50,000. So we've got 40,000, which means instead of £2,300 a month to play with, they can support a repayment of £3,300. Big difference. You've got an extra £1,000 going into your affordability. But then you factor in that their rate, their stressed rate, because they do it on a 5-year deal, they're stressing at 5.6. That means over a 25-year term, same as the high street lender, instead of £300,000, they're going to be talking to you about loans in the region of £525,000. It is nearly double. And that's the difference between high street and specialist. Okay, it's a massive difference. There is another factor which you can take into consideration, because you might not qualify for that specialist lender. You know, they're picky about the businesses that they'll support, but you might not qualify. There is another factor that you can take into consideration, because both high street and this specialist lender, they work out their monthly repayment for their stress and affordability purposes based on a capital repayment loan over 20 or 25 years. There are lenders that will work it out on an interest-only basis. Now, interest-only, if the rate is the same, interest-only is always going to be cheaper per month than a capital repayment, because you're not paying off any of the capital. You're just paying the interest. And that gives you the opportunity to actually borrow more on affordability when it's tight. At the moment, it's not making a lot of difference, because this specialist lender 5.6 is so competitive with their rates that they offset the difference between capital repayment and interest only. But I'll give you an example. Let's say semi-commercial. It's a semi-commercial property you're looking at. You've got your £50,000 to spend. These lenders will tend to work on 125% debt service coverage. For higher taxpayers, they might go up to 145%. But let's say it's 125%. So we've still got £3,330 odd pounds a month to play with. That's the amount we've got to service the loan. So on an interest-only loan at 6.9%, you could potentially raise £570,000. So you can see you can go higher again on interest only. If it's fully commercial, the rates are a bit higher on fully commercial, so you're probably back closer to the 525. So why would you take a deal if it's only going to get you 525,000 at 7.5% or 7.9% when you can get one at 5.6%? So you can see there's lots of factors to take into consideration there. So our job is to look at all the circumstances and underwrite the application, taking into consideration all these circumstances. So when you come to an organisation like Promise Money, the chances are you're going to say, right, I want the maximum amount of borrowing. You might not, but often you want the maximum amount of borrowing and best rates. So our job is to take all of the factors into consideration. Tips: if you're looking for the maximum amount and the best rates, keep your profits high, keep your dividends low, or at least keep your personal outgoings low so that we can add them back. And let us see the accounts at the earliest possible stage, especially if you're thinking of filing your accounts soon. What you don't want to do is file your accounts and then find they're not enough to do the loan, when you might have left something not in the accounts because you wanted it into the next year or something like that. So let us see the accounts at the early stage, and then what we'll do is we'll underwrite the application. We just need to know the whole story, what you're looking to do, and factors that are going to determine which lenders we go to or which lenders are available are going to be location, the business type, the age of the applicants, that could have a factor. The use of the money, what's the purpose of it? Is it to do it? Is it to use within the business, or is it to take out the business? The property type that it's going to be secured against, the condition of the property, and then obviously the accounts and the sort of things that lenders want to see at an early stage, and we like to see at an early stage because we want to assess it before we send it to the lenders. Last 3 years accounts, an ALI, that's the assets, liability, income and expenditure statement, which is it's one piece of A4 with just a few numbers on, but they're important numbers, and we'll send one of those out to you. and business and personal bank statements. Those are the key things. By the way, if you do have an overdraft, make sure you stay within it. Unauthorized overdraft use does not send a good message to a lender, so avoid that. Keep your bank statements as good as you possibly can. Don't have misdirect debits. Don't have payments to the HMRC which clearly are not your regular payments, i.e. you're catching up on something, or there's a problem. Your bank statements can tell quite a story, so just look after your bank account, make sure it's well conducted. And those are the sort of facts we'll take into consideration. But the main takeaway here is the amount that you can borrow and the rates is vast, and it depends how we approach the application. And your job as a business owner is to make my job as easy as possible by getting everything in the right place. And that means hopefully we can go to lenders where we can get the best rates and the maximum amounts. But fear not, there are lots of other options where not everything has gone according to plan. So we've got a wide range of products. Well, we represent the whole market when it comes to commercial mortgages, so lots of options. I hope I've not bored you with numbers, but I hope I've explained a little bit about the methodology behind it and how important it is to have a good set of accounts, a good set of bank statements. That's it for now. Catch you soon. Bye-bye.